In this video, I'm going to tell you about 3 ways that you can do big real estate deals without ever having to do a syndication. If you've been out there researching on ways to scale your real estate business to do larger apartment deals or even like commercial deals like industrial, retail, and office, you're probably going to come across this word syndication, and then you're going to be bombarded with ads from social media about learning about syndication, real estate syndication, that sort of thing. And what syndication is that it is pooling together investors' capital to buy commercial income producing real estate assets. Okay. It involves the use of the being in compliance of a Securities Exchange Commission, using an SEC attorney. And there's a lot of moving parts and complication around this. I have never done a real estate syndication. I've been in real estate as an investor for 18 years, have built a portfolio of worth $18 million and have never had to do a syndication. And so in this video, I'm going to tell you about the 3 methods you can do so without ever having to do that. So I'd venture to say that there is a time and a place for real estate syndication, but if you're buying any deal that's below $5 million, it should not even be on your radar. The reason being is because when you are putting together a deal, and the typical syndication model when you're pooling together investors' money is that you, as the person who found the deal, put together the bank financing for it and raised the capital for it, typically you're going to only get about 30% of the equity in the actual deal that you do put together. And when you're doing a smaller deal, it really isn't enough to keep you interested. Using the methodology of the 3 ways that I'm going to detail in this video, I've done many millions of dollars worth of deals while keeping all of the equity in those deals. So each one of those deals that I do, I'm actually going to significantly make financial impact on my financial goals, as opposed to watering them down by doing a typical syndication model. Secondly, there is a lot of gurus out there that you see these sponsored ads about that they do this mantra of find the deal and the money will come. So join our program, pay $5,000, $6,000 to join, or even more. I've seen some of these programs that actually interview prospective clients for what I offer in my advisory services that tell me, hey, I spent $10,000 on this mastermind. They taught me how to find deals and how to underwrite them. And when I ask them the question about, well, how do I put together the capital for those deals? They say, don't worry about it. We have all these people in our mastermind that have a ton of money or access to investors, and they'll provide the money for you. Okay. I call these syndicator feeder groups. And what their model is that get a bunch of people to pay a high ticket price to enter their mastermind. And then at the end of the day, if they go out there and find deals that don't meet our buying criteria or investors' buying criteria, whether it's based upon unit size or geography or whatever, then we don't have to do it. It's no sweat off our back, right? And so the problem with that is that you go into this scenario and you are out there chasing deals, making offers, and you finally get a deal under contract. And this has happened. I've been on interviews multiple times, and there's no money, there's no investors. And in the meantime, you wasted all this time on not building the relationship infrastructure you needed to source your own capital for those deals. Okay. So that is my manifesto on why syndications are overkill. When you're doing like, let's say 20, 40, $50 million, $100 million deals, then you're just not going to have the relationship infrastructure built out in your own network, which takes time, by the way, because relationships move with the speed of trust, to take down those deals, and a syndication might be appropriate at that point in time. Okay. So here's the 3 ways you can do it without ever having to do a syndication and while keeping most, if not all, of the equity in your deals. Okay. Number 1 is, and this is the method that I train and mentor my clients on, is marrying OPM with bank financing. Okay. So private money with bank financing. Us as real estate investors strongly believe that cash flow will never make you rich. It is the equity appreciation you get in buying assets that are highly desirable, that appreciate over time. You pay debt down on, and you build up equity very quickly on value add commercial deals. For instance, there's a client of mine in Orlando who bought a 22-unit apartment building for $300,000. He needed $400,000 in rehab money. He put this deal together with bank financing and OPM. And fast forward about 11 months, the property reappraised for $1.6 million, and you walked away with an $800,000 check at closing and keeping 100% of the equity in the deal. So this is the method that I prefer, and you can keep 100% of the equity. And how you do this is that you take investors, private investors, this could be friends and family or professional contacts that want cash flow, okay? When you go in the actual discovery process with them and you're asking them, if you were to choose one and only one, would you prefer guaranteed cash flow or no cash flow and upside? All right. A lot of investors that are looking into real estate, they're looking into passive income or truly passive income and guaranteed passive income at that. So what we do is we source private capital from individuals that either leverage assets or their own cash and want to have guaranteed cash flow, guaranteed by me or my clients that I advise, and just get monthly cash flow distributions out of those. And then we marry that desire for cash flow with our desire for equity appreciation over time. We find an opportunity that has significant upside, which we can rapidly increase the value in the asset over, let's say, 6 to 18 months, so that we can buy a property for $1 million, force appreciation to $2 million, bring it back to the bank, get a new loan, more debt on the property, and then use the proceeds from that loan to pay those investors back their money. All right. So that is my primary method for the way I do deals. I just did a deal last year. It was a 60,000 square foot high-rise office building in Rochester, New York. It was a $2.75 million deal that we had under contract, and I had to raise $750,000 worth of cash. And I promised an annual rate of return paid monthly to those investors. We were able to increase the value from that property from $2.75 million to $4.1 million over a 12-month period. And therefore, I had the equity to pay my investors their $750,000 back. Okay. So I've been able to use and rinse and repeat the use of that capital. And oh, by the way, when you do it once on your proving grounds in your first larger deal, you are actually building a relationship. And there's no better way to build a relationship than sending little monthly love letters to your investment partners in the form of cash flow distributions to them based upon the money they lent to you in that deal. Okay. So second method is seller financing. There is a tremendous amount of seller financing opportunities that are out there in our marketplace. In a high interest rate environment, there is this thing called the bid-ask spread, where sellers' expectations in terms of pricing are not in line with the market. All right. Interest rates are higher, so therefore investors have to pay more to their passive investors, and also the annual debt service on those properties is higher and cannot support the pricing that those sellers want or expect from those opportunities. So seller financing kind of offers the best of both worlds. One, you can get the seller a higher price because you're customizing financing, and the sky is the limit on what you can customize on, right? So you can have interest-only periods, all right? You can have customize the interest rate, the term, everything. So you can afford to pay them a higher price if you are customizing financing terms with them. They're advantageous to you and your deal, all right? And with this, you never have to, and I've done deals where I've had them 100% seller financed, right? Why would a seller want to do that? This is also the discovery process with the actual property owner themselves. So when you're educating them on this, and this is a question I ask with sellers I'm talking to directly, right? Not with a broker, although I have a methodology for kind of getting through the gatekeeper with the gatekeeper who's the broker to engage in the conversation about seller financing. But the question I ask is this, do you prefer a lump sum cash at closing, or would you like to defer your capital gains taxes on your property and get a stream of income off of the property? All right. When you ask them that question, they're gonna be like, well, what is that? All right. Asking the question of, will you hold the mortgage, screams to the property owner that, hey, I'm broke. Will you hold the mortgage for me? And then when they ask what does that mean? A stream of income after closing and defer my capital gains tax. Then you can engage into, well, whatever I put down on the property, that's what you're going to pay capital gains tax on next year. Okay. So we can either defer more or less capital gains. If you want 50% down, you're going to pay more capital gains tax on that because it is an installment sale, right? The other trick too is if it is an interest only payments and you're not paying down any principal, let's say over the first, like let's say 5 years, for instance, whatever you can negotiate that is mutually acceptable to both you and the seller is that you can actually have them only pay ordinary income on the interest if they're doing interest only on that deal. All right. So they could essentially defer their capital gains for however long they want to do an interest only period and also doing 0% down. Now, not everybody is going to be for this. Some people want to have cash for financial reasons, financial motivation, or also just for the psychological reason of like they want you to have skin in the game. All right. Some asset classes, or one asset class that is specifically where seller financing is very prevalent, is in the mobile home park space. Typically, a lot of the mobile home park operators that are out there bought their property through seller financing. And the reason is because a lot of mobile home parks have what's called park-owned homes, and banks sometimes won't even finance park-owned home communities. All right. It's kind of silly. Models are changing, but also if the bank will do it, they won't associate any value with those park-owned homes. So you're just going to be based upon the lot rent, for instance. So seller financing, even like extremely creative 0% down seller financing, is very prevalent within mobile home park space. That's just kind of like a side note. All right. So seller financing. Third, how to purchase properties without ever having to do a syndication is joint ventures. And what joint ventures are is that it's a partnership between you and maybe a couple other investors. Typically, I have never done a joint venture with over 5 investors, for instance. And each one of you brings something to the table. All right. So you could be bringing the deal to the table. All right. You could be bringing the management capacity, right, to the table. And then the other investment partners are bringing the cash, for instance, or they're bringing the balance sheet if you're using bank financing that the bank is going to want to see in order for them to be comfortable with having a personal guarantor that they can go after in the event of needing to enforce recourse on a loan in the event of a default, for instance, right? So a joint venture can be customized with the members in the LLC that own the actual real estate, all right? So you can customize an operating agreement with your attorney on what the roles and responsibilities are, what the distributions look like, what of cash flows and tax benefits and that sort of thing. All right. So you can have one partner who wants to get more of the tax benefit with the real estate, for instance. You can have one partner that wants to have the cash flow, for instance. And you could come in saying like, well, I don't care about any of those things. I want the equity appreciation in the deal, for instance, or a substantial amount of it. Okay. Which you can negotiate way better than 30% in the typical syndication model. And lastly, I'll say, and here's how to actually build capacity or relationship infrastructure with joint ventures is getting out there and networking. Go to any meetups you could possibly go to where other active real estate operators are. Okay. And these people don't necessarily need to be experienced in the realm of commercial real estate, but you can find deals that are big enough that will keep everybody interested. All right. So there's a deal right now. I'm sitting in right now at the Wilder building in downtown Rochester. This is going to be a $25 million redevelopment project. All right. So if we only get like, let's say 30 to 40 to 50% of this deal, like that's a home run in our opinion. Okay. Bigger deal, bigger financial upside makes more people interested in participating in it. Try doing that same sort of structure with a fix and flip or a single family rental, for instance. Somebody that's getting a couple $100s a month in cash flow for putting up X amount of dollars in cash is really not going to be interested in that. So in closing, syndication, all right, which I'm bashing on in this video, right, is your original intent as being a buy and hold investor is be able to hold on to the damn thing for as long as you want. Syndicators are essentially glorified house flippers. When you're raising capital from private investors that have equity, you have to promise them a return of their equity at some point in time, which usually results in a sale because you have to get them out, right? You have to get them out of the actual deal itself. When you control all of the equity in a deal, or you're doing it with a small group of people, then you can control that right from the onset. Hey, we are only going to sell this thing when all 3 of us or all 5 of us want to actually dispose of the property. The longer you hold onto property, the more chance you can actually pay down debt over time. Mortgages are front loaded with interest. So the longer you hold on to it, more of your payment actually goes for principal pay down. And also you have the likelihood of increased success on keeping that asset in post stabilization. So hope you got a lot of value out of this. If you are interested in learning more on how you can scale your real estate business into commercial property, buy 10, 20, 30, 50 unit apartment deals or other real estate asset classes, that is what I do. I am a on-demand advisor for my clients. I become a member of their team and their journey from the hardest part of my journey as a real estate investor was graduating from residential to commercial. You do not need to do it alone. I can help. Just make sure to check out the comments below and book in a call. Now, this being said, if you are flat out broke, then we're probably not going to be a right fit for each other. You do have to have some either equity in properties or cash equivalents and other investments in order to really break into this space. If you have like no dollars to your name, I probably cannot help and it would be a waste of your time. So if you do fit in that criteria and have the desire to scale into commercial much faster than it took me. It took me 11 years, 25 properties and 76 doors in order to earn my own financial freedom. And it took one deal in 1 year when I first did my first bigger commercial deal to replace my wife's income. All right. So you do not have to do it the same way it did for me. If you own one property, I've helped investors that own just one property scale into multi-million-dollar deals without having their own capital as a bottleneck into that. So be sure to reach out to me and comment below if I didn't answer anything that is relevant to this conversation, and we'll talk soon.